RBC is saying, who cares? Let's just lend more and more to these people right now into residential real estate. But it is definitely a worrying sign and signal, because you have to ask that question, why would they do this? Why would they lend into a really shit economy even more money whilst they're seeing the risk on their balance sheet of defaults skyrocketing? The credit crunch is here in Canada. You have got 2 banks in Canada that continue to go out on the risk curve and look incredibly risky. Meanwhile, you've got 3 banks that are contracting their credit and their loans. And I'm going to go through all the data with you. This was an extremely popular video that we did with the last quarter's statistics, and I'll link that video in the description and at the end if you haven't seen it, so you can compare what happened. And I just want to go over this real quick once again. So in the financial crisis, or the lead up to the financial crisis in the United States, what you saw happen with lending was it actually continued. This gray area on the chart is the recession that happened, and you'll see that it continued until eventually in 2009 when it actually started going down. And that's very interesting, because we're seeing this continued lending that is happening, but we're seeing that some large banks are really slowing that down whilst others are compensating. So it's a very, very dangerous game. It's like a game of musical chairs. And the bank that is slowing credit growth the most in Canada is TD. TD's loans dropped 4.5% last quarter as per their latest results. So TD's loan book is over $1 trillion, very similar to RBC, but they are doing the exact opposite. And we'll get on to RBC. This is ranked from best to worst, because in my opinion, if a bank is saying, no, I don't want to lend in this shit economy and shit environment, that is a good thing. That's actually what you want to see happen. But if a bank is saying, yes, we want to lend, this is a shit economy, people are losing their jobs, but so what? Let's keep lending. And it all comes down to Ponzi financing, because banks that need to continually lend even during bad times, it's obvious that they're participating in probably Ponzi financing. So the Bank of Montreal, their loans went down 1.48%, and I've added some other banks in here to talk about as well, because what is going on there just completely shocked me. So, and then you've got EQ Bank here, which isn't a chartered bank, and I think that is very interesting to note, because obviously the way they get access to capital is the more traditional banking way, where they've got to have those assets on their balance sheet, where they need the deposits more than, say, a TD bank or an RBC bank. And TD is a chartered bank in both the United States, completely separate entity, to the TD Bank in Canada, which is also a chartered bank. It's one of the biggest banks in North America, believe it or not. So you've got EQ Bank, loans are shrinking there. You've got the Bank of Nova Scotia that is basically flat for their loans. So credit is actually contracting, but it's only slightly contracting at the Bank of Nova Scotia. Laurentian Bank is incredibly interesting, because when you look at their debt to equity ratio, as I pointed out on a video last week, it has absolutely skyrocketed. And obviously the one that I'm most concerned about, and has been a red flag since they reported a loss last year, is Laurentian Bank, which now has a debt to equity ratio of 705%. And that is crazy when you consider that that is nearly double the Royal Bank of Canada's leverage ratios. So they have a load of risk on their balance sheet, but it's actually good, I guess, that they're actually decreasing their loan book size. They're not taking on so many loans right now, because like I said, in an environment of higher unemployment, in a bad shit economy, you don't want to be taking on more loans in that environment. You don't want more risk on your balance sheet. That's when you typically tighten up. But as I said, that doesn't actually mean you're not in a recession. Typically, the tightening really comes a little bit later in the cycle, and Canada is in a recession right now. You don't need the government or some institution to tell you that to realize it. And now we're getting on to the banks that are seeing credit that is skyrocketing. So if you're after credit, I would tap up these banks, because they are lending like there is no tomorrow, especially one of them, which caught me kind of off guard. So CIBC's loan book is up 2.64%. Obviously, we know that CIBC is mostly concentrated in mortgages, and we know that most of these loans at Canadian banks banks, around 60 to 70% of these loans are in fact mortgages. So it's an incredible amount of loans that CIBC has, and that keeps growing. And now we get onto Canada's biggest bank. This is the bank that most people tap up for credit, and this bank is growing loans at an unbelievable rate, especially considering their loan book size. So they have a loan book of $1.1 trillion. I mean, that is absolutely insane. And it grew by 3.77%. And this is all growth during a economy. So ask yourself this question: do you think these loans that the Royal Bank is taking on right now are higher risk because of the economic environment? And we've already seen articles about RBC that's been doing blanket appraisals. We've seen that lending has skyrocketed to developers, and a lot of these condo developers are going bust, and banks aren't going to get paid, and the underlying assets are worth far less than the recorded price, and that's why they're covering it up with blanket appraisals. But I think it's incredibly interesting that you've got this growing so much at Canada's largest bank. I don't think that is a good thing by any stretch of the imagination, but actually for a stock price, for investors, they probably think that that is a good thing. And that's just how backwards sometimes the stock market is, because it prioritizes growth more than actually risk, because even the stock market largely is in a bubble. That doesn't mean it's going to crash. It just means the risk-reward ratios are incredibly skewed. And that still doesn't mean that there are no opportunities in the stock market either. And then you look at National Bank. I mean, this is just crazy. This looks like something straight out of the GFC, which makes me kind of question what is causing this. So National Bank saw their loan book skyrocket by 18.58%. And when you look at a chart like this, it kind of looks very similar to that chart of the lending to developers. So where are a lot of these loans going? Now, obviously they have a smaller loan book, but by no means is it a tiny loan book. They have a loan book of 294 billion now, and that was around 240 billion in the prior quarter. This has just grown at an exponential rate this quarter. So you've got to ask the question, well, where are they lending? What is actually happening right now? When you look at what is going on, you're seeing RBC is seeing mortgage delinquency rates skyrocket. This data right here that was published in the Globe and Mail comes from RBC. So guess what? RBC is saying, who cares? Let's just lend more and more to these people right now into residential real estate, because you look at what's going on with their loan book and they are continually lending in that environment despite the risks rising. And I think that is a huge red flag that people need to be aware of. Doesn't mean the bank's going to go bust or anything like that, but it is definitely a worrying sign and signal, because you have to ask that question, why would they do this? Why would they lend into a really shit economy even more money whilst they're seeing the risk on their balance sheet of default skyrocketing? So, I mean, you look at this trend, you don't have to be a rocket scientist to figure out that that trend is accelerating at a rapid rate right now. And guess what? A lot of these banks, they rely on insurance of mortgages, and that insurance is actually backed by the taxpayer, and they don't have to put any capital towards those insured mortgages, which means essentially they can lend out $500,000 and they have to put $0 away as capital reserves for that loan. So that is just new money that goes into the money supply, and now you understand why housing prices have inflated so much. But in good times, this is all great, but when things start to go wrong and they have to start to claim on that insurance and the government says, actually, you didn't do your due diligence there, so you, we're not giving you the money back on that. And they're also seeing pressure politically because the public don't want to see massive bailouts and they don't want to be funding all these investments that have gone wrong.
And it was recently sold on assignment for $590,000. They're now on the hook to cover the difference.
And now I have a mortgage on this property for $300,000 and I don't own it.
Then you have major problems that happen, and the banks have relied on this for a long time, and this could go very, very wrong because of the capital requirements allocated for these insured mortgages, which is absolutely insane. And even the uninsured mortgages, it's like 10%. So for a $1 million mortgage, that means that they have to put $100,000 up. I mean, that is nothing when you consider the reverse reversal in real estate prices that we have seen over the past 2-3 years, and all the losses that we're seeing. I mean, 10% is absolutely nothing, and that is an over 38% loss on this house. So again, you're just seeing how badly the Toronto housing market is cracking. What do you think is going to happen with that delinquency rate, with unemployment going up? Because interest rates are just a reflection of the economy. They by no means control the economy like these mainstream media economists think, like the Bank of Canada even thinks. So interest rates coming down, they're not going to save this thing, and you're going to see unemployment that continues to go up. And by the way, they're also laying people off at the financial regulator in Canada. So I think it's absolutely a hilarious time right now. You're seeing the regulator in Canada cut jobs, whilst you're seeing the banks, some of them at least, taking on huge extreme risk. And given the data, given everything that is going on right now, I want you guys to let me know in the comments. What do you think? Do you think it's a good thing that they're continually lending more money into a terrible economy right now? Do you think they're going to get repaid these trillions of dollars in loans? Because the loans and the debt levels in Canada are absolutely insane. And since this housing bubble started imploding in 2022, you've seen debt that has grown by over 322 billion, and that is just consumer debt. So it's an absolutely insane amount. Check out this video here, which was what happened with the banks last quarter, because now, given what you've seen in this video, it's very interesting to look back at that. And then if you're looking for a VPN, also want to help support the channel and get the best VPN, check out ExpressVPN, link in the description below, and I will see you in the next one.